Applied Materials reports Wednesday. The options market is charging you 9.9% for that move. Over its last 8 earnings, the stock has averaged 6.8. That gap is the whole business, not a forecast, not a hunch. One number you are charged against one number the stock keeps producing. Here is the only test I run. What the option charges for the earnings move, against what the stock actually did on its last 8 earnings days, measured each quarter, averaged. If the charge sits above the delivery, you sell. If it sits below, you buy. If they are close together, you do nothing, because a point of difference is noise, and it is not worth crossing a spread for. 3 names cleared that bar this week. 3 did not, and those matter more. Applied Materials is the widest gap in the scan, 46% more premium than the history supports. The implied volatility on that contract is 99.6, near 100. That number does not survive the print. It collapses the moment the uncertainty resolves, whichever way the stock goes. So, an iron condor, $8.90 in credit, $1,610 at risk. If the stock does what it has averaged for 2 years, in either direction, it finishes inside the wings and the whole credit is kept. One caveat on that one, and it is not a small one. The call I want to sell is quoted $6.20 bid, $11.40 ask. That is a $5.20 spread on a single option. A mid-price fill is a polite fiction there. Use a limit order. If the call side will not fill above a credit of $2.50, take the put spread on its own and leave the rest. A good trade you cannot get filled at is not a good trade. Cisco reports Wednesday after the close, 28% of excess. What makes this one clean is the skew. The calls and the puts sit within 3/4 of a point of each other. The market saying it genuinely does not know which way this goes. No lean to fight. $1.73 in credit against $327 of risk. Break-even runs from 112.27 up to 132.73. Cisco has not closed outside that band on an earnings day in 2 years. Walmart is the smallest edge of the 3, and the one I would size down. 5.8 charged against 4.7 delivered, 22%. But the puts are carrying almost 7 points more volatility than the calls, and that is not decoration. Downgrades and insider selling, and a real question about whether the low-income shopper is still showing up. The market is paying for protection on one side. So the short put is the leg that hurts. $1.07 in credit, $193 at risk, and I would run the put side 1 contract lighter than the call side. Now, the 3, I did not take. Home Depot has exactly 1 measured earnings move. 1 data point is not a small sample. It is not a sample at all, and an overpricing signal of more than 200% built on a single data point is a coin flip wearing a suit. Analog Devices and BHP are worse. Neither has 1 earnings date I can confirm in the last 800 days. All 3 might be mispriced. I have no way to know, so they are not trades, so 3 trades, and all 3 are the same trade. Applied Materials, 46% of excess premium. Cisco 28, Walmart 22. Each one sells a move the option market is charging more for than the stock has been delivering. None of that says the stock goes nowhere. It says you are being paid above the going rate to take the risk that it does. And the 3 I skipped are the ones I would watch me on. When the history is not measurable, there is no edge to compute, only a story. The discipline is throwing those away. That is this week's scan. If it was useful, subscribe. I do this every Sunday before the week opens. And tell me in the comments which of the 3 you would actually take or which one you think I have wrong. I read them, and the arguments are usually where the next episode comes from. Thanks for watching.